Zach Bassett here with COS Accounting and Tax, doing videos for my Compounding Interests podcast. Today we're going to talk about the Rule of 72, which is the foundation of compounding interests. It is the foundation of everything that I've done in business. I've always thought about this when I've been doing, whether it's tax planning or setting someone up with an entity, this is always in the back of my mind. Because I might be doing a menial task like setting someone up with a business, but I'm thinking about, well, we're going to profit this amount of money. If I do that this many times in a year and then compound that forward 20 years, we're going to be at this point. And it's really easy to kind of envision where your business can and will go if you continue to hit the same growth metrics that you've been planning out or that you've been hitting in the past. So really, really fun to kind of use this throughout your business experience. I would use it as often as possible. If you can get your brain to kind of be reprogrammed to think Rule of 72, you're going to be a lot better off, because whether it's saving $5 at the gas station on treats, instead, you just drink water, or, saving an extra $7 at dinner by not ordering the supersized thing, or whatever it is, you're saving a little bit here, a little bit there, a little bit there. It's going to compound forward. So the Rule of 72 is this. I learned this from the book Money Master the Game by Tony Robbins, one of my favorite books of all time. Super cool, and it has a lot to do with the compounding interests part of what we do, because it's going to compound over time. And the coolest part about tax, saving on taxes, that you can actually increase your net worth instantaneously. There's really no other businesses no other investments that you can just increase your net worth instantly. The reason why you do, when you have, let's say you put $20,000 into a solo 401k, now you've got the same amount of assets because you just took cash and put it over here in the 401k. But now your liabilities, which were, say, $10,000 in taxes, now they go down to $7,000. So you've got a higher net worth instantly. That's awesome. It's as close to instantly as you can get, because obviously you have to set the account up, but it's a lot easier than most other things. So I call it instant. But Rule of 72, let's say you just saved that $3,000 in taxes, and let's say you are 20 years old. So you're 20 years old. And you invest with Fortress Financial, and we continue to average 15%. 15% super high, but mind you that my true rate of return has been over probably 70% for every time I invest money into my own companies. They're growing at massive, growth rates year over year. So if you do that, and that's how businesses are. I'm not like bragging it up on that, but businesses grow at super high growth rates in the beginning years. They slow down over time, but you could get an average of 30, 40% for 10 plus years if you do things right. In this case, we're just going to say 15%, because at some point you're going to want to slow down. You don't want to keep pushing and, every year for 45 years to get the, 20, 30, 40%. You're going to want to slow down and just have some passive investments and all that kind of thing that are going to come into play. But, a lot of people get stuck on, well, it should be 10%. That's what the stock market's average. Well, you can, and people do all the time, beat that for continuous amounts of time. Whenever you see the numbers listed on Forbes magazine or whatever, the reason it gets pulled down from financial investors is because the individual investor calls up on the phone and says, I want to pull my account out when the account has dropped to lows. That happens so much more than you might think. And look at what that does to the financial advisor. If they had kept their money in, like in the 2008, financial crisis, they would have made their money all the way back within a couple of years. So it was, it's just devastating what those types of mistakes by the individual investor can do to the financial investor's numbers. But yeah, 15%, no big deal. This person has 45 years until they're going to retire. So we take that, because they have to start pulling out at 65. That doesn't mean that they're not going to retire at 40 years old. It just means that they're not going to pull money out until 65, because you have to wait till you absolutely have to take money out at age 65. First thing we're going to do is take 72. We're going to go 72 divided by 15, the percentage rate that you want. You don't put in percentage or anything, you just put 72 divided by 15. You get 4.8. That means your money is going to double every 4.8 years. So now we need to say how many years does he have until he has to pull the money out of retirement. That's going to be at age 65. So he has 45 years, give or take a year. So 45 years that he's going to be able to compound his money until he has to pull money out of retirement. Doesn't mean he's not going to retire at the age of 20 or age of 40, because he very well could. But we're talking about, when do you have to pull money out of your retirement accounts? That's the important thing, because we're going to want that money to compound as long as possible without getting any penalties or anything. So now we take 45 divided by 4.8. So let's go 45 divided by 4.8. So then we get 9.375. So that's how many times total it's going to double. Your money is going to double. So let's say the initial amount, he maxed out a solo 401k, and from the savings that he had, and he's going to have, let's just say 21,000 he puts away in the 401k. He also decides to do a Roth IRA, 6,000. So he's got $27,000 to put into this account one time. That's it. Not every year, just once. He's going to now go 27,000 times 2 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 times 1.375, and you get 19,008,000. Yeah, so that number to a lot of people sounds insane. And that's because it is. What you don't realize how much you can do, how much can happen in 40, 45 years. Money compounding doubles every 4.8 years, so it's going to end up at 19,008,000. Now, if you were able to keep it in there for another 4.8 years, it'd be 38 million. So that's 4.8 years goes from 19 to 38 million. Think about that. And then you're at 76 million if you do it again. So crazy once you get to that point, because then you're talking only a few more doubles before you're hitting like 1,000 million or a billion. So to me, that is just this caught my attention. It blew my mind. It excited me to no end to think that, well, I can do a lot more than 27,000 if I want to, if I try. Yeah, that was a lot at first, but then after a while I'm going, I want to get it to where I'm putting away 270,000. So then I actually just add a zero here, 190 million for 1 year's worth. So that's putting 270,000 in one time at 15%. You're going to have 190 million after 45 years. Like that's crazy. One time, 270,000. Yeah, 270 is a ton as well. But hey, I just covered my entire retirement and I'm living in luxury in my retirement, right? If I make that happen, think about that. That's crazy. Well, what if when I'm, 20, 3, I do it again. And every year I continue to do this, you can become a billionaire. This is how people actually become billionaires. It's not because sometimes it's they created Google or whatever and got lucky, but a lot of the times it's because they're using compounding interest to their advantage and using, banks and the ability to leverage your money and get rental properties and let it compound. If you're doing rental properties, this number can be 18%. It could be, let me show you the difference between 15% and 18%. So before we did 15%, let's do the same 27,000. Let's do that. So we've got 27,000, we've got 45 divided by, we got to go 72 divided by 18. So now we've got 4 here. And then we're going to go 45 divided by 4. Now we've got 11.25, making it hard on myself because I can only do this so many times, but we'll try it. Okay, so 11.25, he's gonna double his money. That's gonna be a lot. So we're gonna go 27,000 times 2 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 times 1.25. So now you've got 69,120,000. Wrong marker. So before you had 19 million, now you've got 69,120,000. Tell me that's not crazy, right? It doesn't seem to make sense. You only made 3% more per year. Just imagine if we checked at 28%. That's going to be $1 billion. So it's really, really cool to see what it can do. I urge you to use this whenever you're thinking about saving, $10. Even, if you take $2,700 and you do the same thing with it, you've got, instead of 19 million, you've got 9 million. So it's still a lot. You're saving a lot of money just with every time you're saving $1,000, $2,000, or even $5. Because if you do $5 enough times, it becomes 5,000 soon enough, and that 5,000 becomes one of these big numbers. A lot of people ask me on this. They say, well, I don't really care to have $1 billion when I'm 65. I'm not gonna pay this any mind. It's dumb. Well, to them, I say, you've got a lot to learn. You don't know what you're talking about. But really, they don't, because this money here is going to be, you're going to live, you want to live to be 65 and older, do you not? I'd say most of you say yes. Some of you won't, but most will say yes. You're also going to live to be now to 65. So while this account is sitting there compounding, growing, hitting new highs every year, and you're putting more into it, what's growing? Your net worth. What does that do for you? Makes it so you can do more rental properties, more passive investments. So it also gives you collateral in your account. So when the bank says we need more collateral, well, yeah, use my $1 million retirement account or whatever it is. They're going to be super happy seeing that on your balance sheet, and you're going to be able to do many more properties than if you had not done this strategy with the retirement planning in 401ks. That's my biggest thing. My biggest statement is to say that you will do more properties by doing this way, and you will also be planning for 65 and older than if you were to just go ahead and not do the retirement plans and just hope that your rental properties get you everywhere you need to be. Not to mention you're going to get a crazy amount of diversification. You're no longer going to be just hoping that real estate does well, because oftentimes something like, not often, but now and again, something like COVID-19 or the pandemic comes around and affects the markets in a big way. There's many people going bankrupt on their properties right now. We have short-term rentals right now that are just getting absolutely destroyed with no rents. So yeah, why not diversify and also be in like your solo 401k? This guy now is in 1,000 different companies across the world. Really, how is he gonna lose all of his money? He's really not going to unless the entire world economy collapses. But this guy, just his 5, 6 different or 20, 30, whatever properties, if there's something like COVID-19 that affects all of them and suddenly he can't make the monthlies, bankrupt, he's done. So it happens all the time. That's why people say, be careful. They're not just saying that to be like your dad and mom. People actually get bankrupted all the time that were doing amazing because of something like 2008 or COVID-19 or so on and so forth. So make good decisions, diversify. This is good for now, all the way till when you die. I personally think of my retirement account as what I'm going to give inheritance to my kids, grandkids, and all that stuff. And then from now until I'm 65, I'm going to build my empire of rental and passive income. So keep that in mind with all the different stuff that we talk about, and use it in your everyday practice. I'm telling you, it will help a lot. It'll make it so you stop spending money in such bad ways. If anyone has questions related to this, please ask. I'll be happy to run through any other scenarios. But this is the gist of it. You can run through it as many different ways as you want from home. Enjoy.